Do you know the reason why I started actually investing and why I love it so much? The answer is very simple. It's two words: compound interest. Now, those two words by itself may not sound very interesting, but let me show you what I mean. That's much more exciting, isn't it? My portfolio from today in 40 years, if I continue doing what I do, will reach apparently 22.5 million euros. Unbelievable. I'll get back to those numbers, how I got to them in a moment. But in this video, my goal is to really get you excited about investing and show you the power of compound interest, because it's often so overlooked and people only focus on what to invest in. But often while people say they're long-term investors, I often see they forgot to zoom out and see the really big picture for many, many years ahead. Now I get it. 10, 20, 30, 40 years in the future may sound like a crazy distance if you're just starting off investing. Maybe you have your first job or graduated university. But trust me, time is flying faster than you know, and the seeds that you're planting today for your financial future matter more than you think. And in this video, I want to show you different examples on the calculator to give you an idea of what your money could turn into over time. Now, when I talk about compound interest, I see two main problems. Number one is for beginners, especially when they're starting off, they say, Kai, well, I can only afford to invest 100 euros. And I totally get it, right? I've been there myself. I invested even less in the beginning. It was like 50 euros a month. And of course, 10% return on 100 euros is, well, if you do the math, 10 euros in a year, let's say, if you don't add any more money. That's not very exciting, right? I totally get it. But once again, we have to see the big picture and the long term. And as I said, I'll run some numbers in a moment that get you excited to start putting even small amounts towards your investments, and you'll see the compound interest over time. Now, on the other extreme, when we talk about compound interest, is when we talk about people like Warren Buffett. So this is Warren Buffett, one of the greatest investors in the world, who's still alive, amazing, charismatic gentleman. Definitely recommend you to read some books or watch some of his talks that he gives regularly. But basically, you can see here in the beginning, obviously, he was still rather wealthy, right? I mean, that was many years ago. So $1 million back then was worth way more than it is today. But be it as it may, you can see the growth, while still being big, only really started kicking off later in the years. And of course, it's always easy to show these charts and say, see, he did it, so you can do as well. But those numbers are really unrelatable for many of us, myself included, right? When we talk about millions or billions, I mean, I obviously have very ambitious goal for myself, but being a billionaire, well, I'm not ruling it out. But again, I want to be conservative and realistic with my investments. If it happens, it happens. I'm not saying you can't, but I think a lot of beginner investors, they sometimes get scared when they see such big numbers and say, well, I cannot relate to that and it doesn't make sense. Investing is only for the rich. So why do I even get started? I better use that money that I plan to invest and use it for my everyday expenses, because I need the money right now. Things are getting expensive and I don't have time to invest in the money. I will never reach a portfolio size like Mr. Warren Buffett or others of millions. And this is really a wrong approach. While you don't have to compete with people like that, you do want to invest in yourself and plan your financial future, because some countries, they still have some kind of pension plans in place. But honestly speaking, I don't bank on that. I want to be providing for my own and my family's financial future going forward. And for that, I need to take charge of it and start investing and benefit from compound growth over time. Right, so here we are inside one of my favorite compound interest calculators. I'll leave the link to the calculator in the description below so you can run your own numbers afterwards. I really checked out a lot of them, and some of the calculators are really way too simplified, which are missing crucial information, while others are too complicated and overwhelming, so people don't end up using it. So that's why I really like this calculator. Maybe it's not the most visually pleasing, but it has some really crucial points. And one very important point, which a lot of calculators don't have, I'll come to this in a second. So first off, obviously, you want to select your currency. The principle stays the same regardless of the currencies. And I want to go through a couple of different examples, starting with really very little to invest and working our way up. And of course, in the end, also share with you how I got to the number I showed you in the beginning with my own numbers, so you can see how that would work out over time. So for the first calculation, I want to assume a student who goes twice a day to Starbucks, maybe before university and afterwards, just with friends to hang out. And on average, I really want to be very conservative. A Starbucks coffee will cost you 5 euros. Now, I'm right now in Dubai, where actually a coffee costs me 8 euros. I mean, it's crazy. So imagine doing that twice, that's 16 euros. But let's just imagine maybe you don't go to Starbucks, but some other coffee shop. I think 5 euros for a coffee is very common these days, depending on where you live, of course. So if you do that twice, that's 10 euros a day. And by the way, I used to do that as well. And I still do from time to time, even though I use that time to really network with other people who meet up at a coffee shop. If I'm by myself, I prefer just to make my coffee at home, which by the way, I do now. This cost me around 20 cents per cup. It's a cold brew. It tastes even better. It's amazing and makes financial sense. Yeah, really very good. Right, so let's go back into the calculator and run those numbers. So initial investments basically means, do you have already some money that you have invested or have on the sideline on your bank account that you can use for the investments? And in this case, we really assume a full beginner who never invested before. So let's leave that blank at 0. So you don't have any amount to invest. Interest rate, that's very important. Here, obviously, it depends on what you're investing in, right? The more risky your investments, the higher the return. The less risky the investment, the lesser the return. For example, if you left all your money in a bank account or a stockbroker such as Trading 212, where you can currently get 4% on your euros, so that would be a 4% return, right? On the stock market, for example, if you invest like me into the S&P 500, historically, that returned anywhere from 8 to 10% over the last 30, 40 years. So let's assume that, because I think S&P 500 investment really resonates with a lot of people. Of course, I could also talk about Bitcoin, which historically had a higher return, but that's more on the extreme side. I really want to have conservative investment estimations over here. So let's go, as I said, anywhere from 8 to 10%. So let's go with the middle ground. So let's assume a 9% interest, basically rate of return for you. And of course, it's annually, right? It's not paid out monthly. That would be great, but it's actually an annual return. Then we look at the compounding frequency, and you can leave it at annual because usually it's returned annually, but that assumes that you don't make monthly contributions, which in this example, I actually want to have monthly contributions. So I'm going to have compound frequency at monthly. And then, of course, we come to the number of years. Now, naturally, I talk about long-term investing. So the longer you keep your money and keep investing and contributing towards, obviously, the larger your portfolio is. So if I show you 5 years, the difference won't be that huge, but I really want to make a point and show you need to have a long-term time horizon. So I really want to go for 40 years. Now, if you're starting off in your 20s, you can easily have 50 years, right? The life expectancy of humans gets longer and longer. I personally plan to reach at least 120 years, and I really invest a lot into my health. I exercise every single day pretty much. I look after my health. I don't smoke, I don't drink, I sleep well. But let's assume 40 years, even for me right now, I'm 38, 40 years will bring me to 78. So definitely very much doable. So let's assume 40 years just to drive the point home also and to really see the results over time. Now then we talk about additional contributions. And here you obviously want to make contributions. So leave it on deposits. So the deposit amount is basically what you save by not going to Starbucks or any other coffee shops, which is the 10 euros per day, right? And then we multiply that times the days of the month, so on average 30 days. So that will be 300 euros a month that instead of spending on coffees, you will allocate towards your investments. So let's go ahead and enter the 300 monthly contribution over here. Deposits made at the beginning of the period, at the end. Let's leave it at the end. It's really up to you. It doesn't really make a huge difference. And that's a very important box over here that many calculators don't consider. And that's the increase of your deposits. For example, if you're in a job and you earn money and use some of that salary that you get towards your contributions, naturally over 40 years, I hope for you at least, that your income also grows. Therefore, your contribution growth, right? You're not going to be allocating the same amount for the next 40 years. Well, hopefully not. Over time, your income grows and your contributions should also grow. Now, in the coffee example over here, obviously, your contributions doesn't grow unless you start drinking more coffee. But most likely what's going to happen is that the price for coffee will increase over time, right? That's inflation. So naturally, prices are going up. And again, we've seen inflation in recent times from 5 to 10%, but I want to be conservative over here. So let's have an annual increase of, let's say, 3% for coffee, because coffee prices have been increasing over recent times. With this, we go ahead and, well, my friends, there we have it. Your portfolio would grow to 1.9 million. Absolutely mind-boggling. So maybe next time you go to Starbucks, think about that number, and maybe instead of spending on it, go to your broker and spend that money on your broker instead. But honestly, that number for me was really mind-boggling. And honestly, you might find it too extreme. So let me lower the number of years. So maybe we'll only do 30 years, which is still a long period. I get it. But it's still a significant number, 723,000. So here you also see really the difference of an additional 10 years, because that's exactly the compounding. If I go to chart over here, you see how it grows over time. It's not simple interest. We see over here, they have also simple interest when it's a straight line. But here it's exponential growth. It grows faster and faster with every year. Because as I said at the beginning of the video, 10% of 100 is, well, 10 euros. Not very exciting. So if I now go back to the 40-year period, you will really start seeing the difference. And that reminds me again of the Warren Buffett chart I shown you earlier. In the beginning, it's very slow progress, right? So you see here in the first year, your deposits, the 12 times 300, is 3,600 euros. So from your own money, the interest is only 152 euros. So you actually added more to the portfolio than you got in interest. And that will stay for a while. Until year 14, you will still add more, then you get an interest. But then from year 14, it starts flipping around. If I go a few years ahead to, let's say, year 30, all of a sudden, you in total deposited 171,000, but already got an interest over 500,000. And that's where the compound interest starts really growing. And you see here, the blue line is the deposit and the orange line is the interest, the compound growth over time. And that's really a huge difference. 271,000 from your own money that you didn't spend on coffees, instead invested. And the difference, the accrued interest from your returns in the S&P 500, for example, of course, assuming that will continue to grow that high for that many years, but let's just assume this example, is 1.6 million. So absolutely mind-boggling. In total, you have a balance of 1.9 million. Now, of course, I get that inflation is in place. Also, things are getting more expensive. In 40 years, 1.9 million will also be less valuable than it is today. I totally get it. But still, not having that money in the first place will put you at an even more difficult financial situation. So you want to make sure that your investments grows and outgrows inflation over time, which here is certainly the case. Now, let's take another example of a subscriber who has a family, and he said he can only afford to invest 500 euros a month into the S&P 500 and Nasdaq 100 because the person has 3 young children and recently purchased a house. So well done actually to still managing to contribute so much into your investments. 500 euros is quite an amount, I would say. So let's go ahead and plug those numbers into the calculator. So of course, for the initial investments, I don't know how much you have allocated, but let's imagine it's 0, even though personally I think it's probably already higher. You haven't just started this month. I assume you've done this for a while. And once again, considering that you also invest into Nasdaq 100, which potentially might have higher returns, let's go ahead with the interest rate of 10%. So interest rate is the assumed return that you're expecting from your investments, right? So 10% is still reasonable. Obviously, even the S&P returned up to 10% plus the Nasdaq on top. So let's assume a 10% return. We'll leave it on monthly. And let's say for a 30-year period, and of course, your deposit amount, as you said yourself, is 500 euros monthly. And once again, I really believe it will grow over time. It will have to grow, right? Either you get a second job or a side hustle, or your employer hopefully will give you a raise over time, one way or the other. I really hope that your deposits will be able to grow over time. And again, I'm going to leave it at 3%, which is actually very conservative. To be fair, it should actually be higher. And well, maybe I can really go to 5%. 5% on 500 euros, that's basically 25 euros more next year. So that should be fairly reasonable. I think it's also a challenging goal to make yourself maybe save a bit more to be able to allocate towards your investment. So let's leave it at that, especially considering that it didn't have an initial investment amount listed over here. So let's go ahead and click on calculate. And well, if you're watching this, congratulations, your future value will be 1.7 million euros. Really not too shabby. Your own deposits will be less than 400,000. So the total interest earned is 1.3 million. So really very nice. I don't know your age. Let's say you can do it for another 40 years instead of 30, and your numbers will look even better. It will reach 5.3 million, and you would have contributed from your own money 724,000. And the difference all comes from your gains, your interest over time. So really impressive number when we see that on the chart over here. Once again, in the later stages of your investment journey, you will start really seeing and benefiting from the compound growth. And that's why I'm also such a fan of investing in your health. For me, I always say my health is my most important value, because first of all, if I'm not healthy, I can't serve anyone. I can't be there for my family, my friends. So I want to be healthy. Second of all, I want to benefit from being healthy and enjoy my life later on, right? If I have such a big portfolio amount, I can start paying out some of that money, live life a little bit more, and yeah, just enjoy it, right? What's the point of being 80 years old, have a $5-6 million euro portfolio, but not be able to enjoy it because you're sick at home? So I think it goes hand in hand. Invest in your portfolio, but also invest in your health. Right, and with this, let's go ahead and do my own example. Recently, I posted a video on YouTube where I shared how I invest currently 2,000 euros per month into my various investments. So right now, that's my investable amount. Let's go ahead and plug those numbers in here. My starting capital right now is around 165,000 euros. If I add my Bitcoin and my ETF holdings together, now of course, my real estate is significantly more, but obviously in this example, I just want to base it on that and exclude my real estate because I treat it a different way. So I just want to focus on Bitcoin and ETF holdings over here. Now for the interest rate, obviously, again, I could go with 10%, I could go with 8%. Let's go with the middle ground of 9% return over time, even though I recently started adding the Nasdaq 100 as well. So hopefully slightly higher returns, plus Bitcoin also is a bit higher. But again, I want to be quite conservative with 9%. And I definitely want to go for 40 years because I'm healthy. I invest in my health a lot. And with 78, honestly, watch me. I will still be very fit. I'll be running. I'll be lifting weights. That's my goal. That's my mission. And it's not just me saying, but I really take action and live a healthy lifestyle. As I said, don't smoke, don't drink, get enough sleep, get exercise almost every single day. So for me, that's super important. In terms of contributions, as I said, right now, I add around 2,000 euros, but my goal is definitely to grow that number even further in the future. And I'm really confident that I will. In the past, I was an employee, so I was dependent on my employer, raising my salary year over year, which sometimes happened, sometimes didn't. But now I have my own business. It has been growing since this year, month after month, which is really good to see. So I'm really confident with it that it will continue to grow. But once again, let's be a bit more conservative with 5%. And well, here we have the number. After 40 years, 22.5 million euros. Really not too shabby. I mean, when I see that number, that gets me excited. You know, this is what I mean. That's what gets you excited. Right now, even when I see my annual growth, it's really not that impressive. Majority of my growth still comes from my own deposits, right? But for me, after year 6, you can see in this example, first time I will have more interest getting paid to me than I have deposits. Now, of course, keep in mind that the growth, the S&P 500 is not like a flat line returning you 10% every single year, right? Some years it might be more than 10%, like this year we're in right now. But then you also have some crisis and some recession years where it is negative growth, right? You're technically losing money. But as long as you hold on to it and continue adding to your positions, it will grow over time. And I said historic returns, right? Nobody knows what the future is, but we're just assuming historic returns for the future as well. So if that plays out as it did in the past, well then, yeah, it really starts to compound and add up nicely. And that's what gets me fired up and excited. When I sometimes feel down about investing and maybe think, maybe I could use that money to go on a lavish, nice trip, I look at a chart and I think, oof, yeah, I better start continuing to invest because that way, I mean, it's going to be a really sizable portfolio. And obviously my goal, as I always say, rather than outperforming the market by 1%, 2%, I want to grow my investable amount, my income. So let's say I will continue to grow year over year my deposits by 10%. Now all of a sudden it will be 42 million euros, right? So you can see a major difference just by adding more money into investments over time. And I think that's really reasonable, right? Because next year that would be 2,200 euros per month, which doesn't really seem unreasonable. And then the following year, 10% more and so on and so on. So obviously that's something to keep in mind. But I just wanted to share with you some of those calculations because even for myself, I have to remind myself sometimes of the power of compound interest. We talk about it a lot and we know the concept exists, but when we see numbers like that, it really gets you excited and more importantly, disciplined to keep contributing regularly. Because don't forget, if some of the months or years you will have skipped and not invested, that will of course impact your total returns in the end. So you want to be disciplined and continue to invest really every single month over a long period of time. And that's when you start seeing and benefiting from the miracle of compound growth, or as Albert Einstein called it, the 8th world wonder. Hope you enjoyed the video. If you did, give it a like and maybe share it with someone who needs a little nudge to start their investing journey. Next up, check out this video here. As always, thanks a lot for watching. Stay healthy, get wealthy, and I'll see you in the next one. Ciao.